Welcome to the Deep Dive. Today we're taking a deep plunge into the second quarter 2025 earnings call for MTY Food Group. The company behind dozens and dozens of restaurant brands.
Yeah, over 80 brands now. And the market reaction to these latest results was, pretty immediate and strong.
It certainly was. So we're here to unpack exactly what happened, what drove that sentiment, and what it means for you listening in.
That's right. There was quite a bit to unpack, a real mix of strengths and challenges this quarter. We'll try and distill those key takeaways.
Okay, let's get right into the numbers then. MTY's Q2 fiscal year 2025 revenue first came in at $304.9 million. That actually beat expectations.
It did, yeah, which sounds good on the surface.
But the adjusted EPS, earnings per share, landed at $1.17. And that was, a bit short of the $1.23 the street was looking for.
And that miss, even though revenue beat, that seemed to be the main story for investors. Profitability concerns really took center stage here.
Right. And overall same-store sales, they saw a decline, 1.9%.
Yep. And normalized adjusted EBITDA, that contracted by 5% down to $70 million. So despite the revenue beat, the profitability miss really colored the perception.
So it's a mixed picture right from the top line and bottom line.
Very much so. And it really highlights the shift, Investors are clearly prioritizing profitability now, not just top line growth. It's interesting, net income actually more than doubled.
Doubled? Wow.
Yeah, but hold on, that was largely due to a foreign exchange gain, so not really operational strength driving that huge jump. Overall, the feeling was cautious.
Okay, so FX gains masking, maybe some underlying pressure. You mentioned that profitability miss was key. Management themselves actually called the quarter a tale of two geographies. I found that description really interesting.
It's a good way to put it.
Let's unpack that.
Yeah.
So Canada apparently was the bright spot.
Definitely. Same-store sales in Canada were actually up 1.4%. And management said it was pretty broad-based strength across most banners there. Casual dining did particularly well.
Okay, so Canada's holding up. What are the other side of that tale? The U.S.
Well, that's where the story turns. The U.S. market saw a 3.8% decline in same-store sales.
Ouch. 3.8%.
Yeah. And again, management described it as broad-based softness, so hitting big names like Cold Stone Creamery, Wetzels, Pretzels. There were some isolated bright spots like Villa Fresh Italian Kitchen, but overall, definitely softer.
And they mentioned choppiness in Q1 for the U.S. consumer.
Right, and what they said this time was that choppiness became more consistent in the negative during Q2, which kind of aligns with what we're hearing across the industry, frankly.
But management is saying these U.S. headwinds are transitory, just temporary.
That's the message, yes. They believe it's transitory.
Okay, so if they think it's temporary, what are they actually doing about it? What are the strategic moves here?
That's the key question, isn't it? Beyond the numbers, they are making some operational shifts. Product innovation, for example. They highlighted significant improvements there. How so? Well, apparently most brands are now planning new product launches 12 to 15 months in advance. That's a big change from just a few months ago, apparently. Much more forward-looking.
Okay, longer planning horizon. Makes sense. What else?
Digital. Definitely a focus. Digital sales were up 3% this quarter. They now make up 21% of total system sales.
21%, that's significant.
It is. And the plan is to take what's working well in the U.S. digitally and roll it out to Canada and some of the smaller U.S. brands too.
And infrastructure.
Yeah.
Anything happening on the back end?
Yes, the ERP system implementation. They celebrated the Canadian go-live, said it was completed on time and on budget. The U.S. rollout is next, planned in 2 phases for October and December this year.
So innovation, digital, back-end systems, all aimed at improving efficiency and the customer experience, presumably.
Exactly. The goal they stated is enhancing dynamism, creativity, agility, making the whole operation smoother and better for customers. These things take time to pay off, though.
Right, these aren't overnight fixes. Now, let's talk about the actual stores, the network. Q2 saw a net decrease, but only by one location, right? 76 open, 77 closed.
Just one, yeah. And management sounded quite confident about getting back to net location growth over the medium to long term.
They mentioned the pipeline.
They did. 108 locations currently under construction. And they said Q3 started strong with 35 new openings just in June. So the pipeline seems active.
Okay, but let's connect this back to profitability. You mentioned earlier the corporate store segment was a drag.
Yes, and this is a really crucial point. There was a strategic decision, mostly late last year and early this year, to actually take back ownership of nearly 50 underperforming Papa Murphy's locations.
Take them back from franchisees.
Exactly. And these were stores that were losing money. So taking them onto the corporate books directly hit the normalized adjusted EBITDA, especially those corporate store margins.
So they bought back struggling stores. What's the plan now? Just run them?
No, the plan is to turn them around and then refranchise them once they're profitable again. It's quite a hands-on approach. They've already successfully refranchised one of them.
Okay, turn them around and sell them back out. How long do they expect that turnaround to take?
They estimated about 9 to 12 months for these locations.
Nearly 50 stores in 9 to 12 months. That sounds, well, ambitious, especially in the current U.S. environment.
It is ambitious, and it carries risks, obviously. Finding good managers, dealing with that softer consumer traffic we talked about.
Are other U.S. brands getting similar treatment? I think they mentioned Baton Rouge and Granite City undergoing transformative changes.
Yeah, they touched on those. Baton Rouge is smaller, but historically profitable, so swings there matter. They're trying to franchise it for the first time, actually.
Franchising Baton Rouge. Interesting.
Yeah, and they've brought in an external firm to look at operations, figure out why sales and traffic are down. Alcohol mix was mentioned as a factor, and basically how to win customers back. There have been management changes too.
And Granite City.
That's another smaller chain. All corporate stores, it's a brewery concept, so very reliant on alcohol sales. They're also feeling the pressure, and the team's actively looking for solutions, trying to figure out how to bring people back, maybe focusing on things beyond just the beer.
So it sounds like they're acknowledging issues in specific corporate-run brands and trying to fix them. But it does raise questions about maybe their capacity as a corporate store operator in some cases.
Well, they stated they believe they have excellent people to run the corporate stores, and they've reinvested in that structure in Canada recently. But yeah, finding enough quality restaurant managers, especially in the U.S. right now, is a challenge they acknowledge is ongoing.
Okay, despite those corporate store margin pressures, how did the other segments do on profitability? Franchising and retail.
They actually did quite well. The franchising segment saw 3% growth in normalized adjusted EBITDA, and the margins there were very strong, 53%.
53% margins in franchising. Wow.
Yeah, that's the beauty of the franchise model, right? And the retail segment grew its EBITDA by 9% with 12% margins. So those parts of the business are performing solidly.
And the 9% margin for the corporate segment, even with the Papa Murphy's drag. How does management view that?
They actually describe that 9% as a healthy and acceptable level, given the mix of businesses they have in that segment now. Interestingly, they even said last year's higher margins were perhaps a little bit too high. So maybe a normalization there.
Okay. What about overall financial health? Cash flow? Debt?
Still generating strong cash flow. About $40 million from operations in Q2 and roughly $4 million in free cash flow after lease payments. And they noted Q2 is usually a seasonally lower quarter for cash flow anyway.
And how are they using that cash?
Sticking to their balanced capital allocation strategy, they bought back shares, almost 300,000 shares for $12.6 million in Q2.
Okay, so share repurchases are active.
Yep. And dividends, of course, about $7.6 million paid out. They also reduced net debt slightly since the end of last year, down to $623.5 million. That puts their debt to EBITDA ratio around 2.4 times.
2.4 times. That sounds pretty healthy. It gives them flexibility.
Yeah, that's considered quite manageable. Provides flexibility for future M&A if the right opportunities come along.
Right. So let's circle back to the market reaction. The stock dropped over 13% on the day. Huge volume. Clearly that EPS misspooked investors.
Absolutely. The buy-side tone definitely turned offensive. That revenue beat just got completely overshadowed by the profitability concerns and the cautious talk about U.S. traffic.
Did analysts react quickly?
Oh, yeah. We saw analysts starting to trim their earnings models for future years almost immediately.
How did MTY's drop compare to peers, other big restaurant franchisers?
That's interesting. Peers with significant U.S. exposure, like Restaurant Brands International or Dine Brands, they also dipped, but their declines were much milder.
Okay, so MTY fell harder. What does that suggest?
It suggests the market viewed MTY's issues as, at least partly, idiosyncratic, meaning specific to MTY, not just a reflection of the overall industry headwinds.
So maybe related to those Papa Murphy's takebacks and turnarounds we discussed?
Could be part of it, yes. Those internal strategic decisions have unique financial impacts. Also worth noting, the stock was already down about 14% since mid-May before earnings.
Oh, really? Why was that?
A couple of target price cuts from analysts, and they renewed their NCIB, their share buyback program. Sometimes the market reads an NCSB renewal as a sign that maybe big M&A isn't imminent, right? Because they're planning to spend cash on buybacks instead.
Ah, interesting interpretation. So the earnings drop came on top of that weakness.
Exactly. It created a gap down on the chart, which increased technical selling pressure. But on the flip side, the lower price makes future share buybacks more accretive mathematically.
Okay. What did management say about future capital allocation? You mentioned M&A flexibility, but are they leaning more towards buybacks, debt paydown, or deals right now?
Their commentary suggested a current focus on paying down debt more aggressively, especially because U.S. interest rates haven't come down as fast as maybe some hoped.
So debt reduction is a priority. What about M&A?
They described the M&A environment as challenging. Sellers often have, let's say, optimistic expectations on price. MTY stressed they're being disciplined. They don't want to overpay, especially not for fixer-uppers or even for good networks if the price multiples are sky high.
Discipline is key, especially now.
Yeah.
So M&A is possible, but they're not chasing deals.
That seems to be the stance. They mentioned remaining open to SIBs, substantial issuer bids, or M&A, but discipline first.
Got it. One specific risk I saw mentioned was Papa Murphy's again. It's exposure to the S&IP program, Supplemental Nutrition Assistance Program.
Yeah, that came up. Apparently 90% of Papa Murphy's sales come via SNIP customers. So any potential legislative changes impacting that program could be a significant risk for that specific brand.
90%. Wow, that's high exposure. And just looking ahead, the macro picture, what did they say about Q3 so far?
Based on June data, the message was basically more of the same. Not getting worse, but not really getting better either. No big change in visibility.
Okay, steady as she goes, but steady isn't great in the U.S. right now. Any other forward-looking nuggets? CapEx, store closures.
They expect lower capital expenditures overall for 2025, with only about $2 million left for that SAP, the ERP implementation, and the Q2 store closure rate. They felt that was probably a reasonable average to expect for future quarters.
All right. Let's shift gears. This next segment is purely for informational purposes. It is absolutely not financial advice. Consider this a hypothetical idea, maybe something you'd pitch to an investment committee, just for discussion.
Okay, disclaimer noted. Here's a thought, potentially outrageous but plausible, as you say, a pairs trade.
Okay, pairs trade. Long one, short another. What's the idea?
The go long MTY food group, MTY.TO on the TSX, and short a comparable U.S. heavy quick service peer, maybe someone like Restaurant Brands International, QSR, or Dine Brands Global, DIN.
Long MTY, short a U.S. peer. What's the rationale behind that?
Well, remember we talked about MTY's big 13.3% drop being seen as partly idiosyncratic, specific to them.
Right, not just industry-wide woes.
Exactly. So the thinking is, maybe the market overreacted to MTY's specific issues. You've got the Canadian operations acting as a buffer, a real bright spot. You've got management with a clear, albeit ambitious, hands-on plan for those underperforming U.S. corporate stores like Papa Murphy's with that refranchising model.
And the price drop makes buybacks more effective.
Correct. So you're potentially buying MTY after an oversold situation driven by company-specific factors that management is actively addressing. On the other side, you short a peer like QSR or DIN. They face the same broad U.S. macro headwinds, maybe even more directly, without MTY's Canadian diversification.
But the stocks didn't fall as hard.
Right. Their corrections were milder. So the trade aims to capitalize on MTY possibly being undervalued relative to its specific issues and its turnaround potential, while hedging against that general U.S. consumer softness by being short a heavily U.S.-exposed peer.
Interesting. So you capture MTY's potential idiosyncratic recovery while neutralizing some of the sector risk.
That's the hypothetical logic, yes. Betting on MTY's specific turnaround efforts relative to peers facing similar broad challenges.
Okay, a thought-provoking idea there. So that wraps up our deep dive into MTY Food Group's Q2 earnings. A real mix, wasn't it? Canadian strength, significant U.S. challenges, but also these proactive steps from management trying to navigate it all.
Definitely a complex quarter. And the big question lingers, As MTY pushes forward with these turnarounds, especially the Papa Murphy's refranchising, how will the market balance those internal improvement efforts against these persistent broader economic pressures on consumers, particularly in the U.S.?
Yeah, what does that tale of two geographies really tell us about resilience, about regional differences within the restaurant industry itself right now? Lots to think about.
Indeed. It's a dynamic situation.
And just to reiterate one last time, Nothing in our discussion today constitutes financial advice. Please do your own research. We encourage you to continue exploring these complex market dynamics yourself. Thanks for joining us on the deep dive.